Well, if you think about the conflict, the initial reaction to the conflict, Russia-Ukraine back in 2022, we saw that initial pop, and then sentiment settled down. This is really no different in my view. I understand it's very treacherous right now, but I would suggest to you this, that the markets seem to be reacting fairly rationally to what we are seeing with this volatility. Keep in mind that the equities, the energy equities, are lagging this pop in the over the last 2 days for both crude and also for natural gas. Natural gas here in the U.S., Henry Hub benchmark, that seems to be much more tame relative to TI and Brent. Of course, the dynamics there are somewhat different. But I think if you would have asked me Sunday what I would have expected, the volatility is definitely there. This seems to be fairly in line. I would say that if the infrastructure gets destroyed, if marine logistics become an issue, supply chains become an issue, a more permanent issue, then I think all bets are off, and the uncertainty will prevail over rational minds.
Talk to us about China's role in all of this. They are the biggest buyer of Iran's LNG, and they tried or have been trying to persuade the country from targeting vital energy export infrastructure. How do they fit in here, and what are the best case and worst case scenarios for them?
Well, we spoke on this over the weekend, and if we were to look at China's preparation for this, there is roughly, call it 50 million barrels of floating storage right now in the Asia corridor. That's a significant supply that is available to not only China, but also the Asian buyers. China has been stocking oil significantly. There's roughly 2 billion barrels of capacity. I think there's somewhere around 1.5 billion in storage at the moment. The IEA suggests somewhere around 90 days of demand. I believe that China is somewhere north of 120 days at the moment. So there seems to be sufficient stockpiling at the moment. Now, as we move forward, again, if we're talking more about destruction as opposed to delays or disruption, then I think all bets are off, and we could see a triple handle on Brent and TI. But when we talk about natural gas here in the U.S., we just put out a note this morning talking about how the U.S. operators are somewhat more isolated and insulated from all that's going on right now, and how we should not expect any incremental barrels coming into the market or incremental molecules coming into the market to take advantage of this price rise. If anything, you'll probably see the opposite happen, more hedging by the U.S. operators, since capital discipline, the mantra of capital discipline that shareholders desire, that remains, and that remains persistent for 2026 in our view.
Hey, Vince, when and to what degree will we see higher prices at the pump?
Well, you would most likely start to see it as we move into the spring session. Of course, summer is just around the corner as well, so it does take some time to funnel through more sustainably across the U.S., but you would see that bleeding in, considering that wholesale prices are now up as well.
So, Vince, what's the role in OPEC here? Are they just going to open up the spigots and take advantage of higher prices?
So earlier they suggested that they would delay any action. I believe, considering where we stand today, you could see them propose loosening balances, providing additional capacity. Of course, Saudi has the most excess capacity, and you could see it introduce barrels into the market, or suggest that they will introduce barrels into the market to sort of calm the market somewhat.